Welcome to class, students. Today we'll be looking at a very important course titled Insurance and Actuary Services, and underneath we'll be looking at Module 1, Introduction to Insurance and Actuary Services. So the module content is Introduction, Core Service and Functions, Application across the insurance industry, Modeling and forecasting techniques, probability theory and statistical method in actuarial work, application in insurance, life contingencies, mortality table and applications. Insurance and actuarial services are specialized fields that uses mathematical and statistical methods to assess risks in insurance, finance and other industries. The foundation of actuarial work rests on four key pillars: probability theory and statistical method, life contingency and mortality tables, actuarial modeling and forecasting techniques, and credibility theory with experience rating. This comprehensive note explores each of these foundational areas in depth. Core services and functions. Risk assessment. Actuaries analyze data to quantify the financial risks associated with potential future events, which is fundamental to the insurance business. Product development. They help in designing and pricing insurance products by analyzing risks, determining this stemming premiums and ensuring the profitability of the products offered. Financial management. This includes managing technical reserves, ensuring solvency, and preparing financial condition reports to meet regulatory requirements. Strategic planning. Actuarial services provide insights that support overall business planning for developing strategies to identify and capitalizing on profitable opportunities. Application across the insurance industry. We have the life insurance. Can be insurance industry can be apply the life insurance, general insurance, reinsurance, employee benefits. So let's look at life insurance. Actuaries use mortality tables and compound interest to analyze risks and develop policies for products like annuities. We also have general insurance. The same principles are applied to other types of insurance such as property and liability to assess and manage risks. We also have reinsurance. Actuaries are involved in designing and pricing reinsurance arrangements, which are a way of insurance companies to transfer risks. We have employee benefits. Actuarial services are used to value and manage employees' benefit plans and post-retirement medical scheme. Actuaries also use sophisticated modeling and forecasting techniques such as time series analysis and exponential smoothing to predict future financial outcomes like claims and reserves. They incorporate credibility theory and experience rating to balance past data with broader industry trends, ensuring pricing and financial stability are realistic. Modeling and forecasting techniques. We have the probability theory and statistical method. Core application. Actuarial science heavily relies on the mathematics of probability and statistics to understand and quantify uncertainty in future events. Key concepts. This involves using probability distribution to model the likelihood of different outcomes like claims or deaths, and applying statistical methods to analyze data and make informed predictions. Life contingencies and mortality tables. Life tables. These tables are fundamental, providing predictable patterns of longevity and death for groups of people based on age and other demographics. Life contingencies. This AI uses life tables and probability to analyze financial risks related to life events such as the likelihood of someone dying, surviving or becoming disabled. Application. This forms the basis for insurance and pension plans, where actuaries calculate premiums and benefits based on probability of future life events. We have actuarial modeling and forecasting techniques. Statistical modeling. Actuaries build statistical models to forecast financial outcome. Forecasting models. This includes time series analysis, which uses techniques like moving averages and exponential smoothing to predict future trends in data such as claims, premiums, and services. Application models are used to project future financial needs, assess longevity risks, and evaluate the financial stability of long-term commitments like pension funds. Credibility theory and experience rating. Credibility theory. This theory helps actuaries determine how much confidence to place in their own past data versus broader generalized data when making future prediction. Experience rating is the process of using a specific group's or individual past experience, their claims or their claims history to set future premiums or other costs. Balance. Credibility theory allows actuaries to balance the stability of the overall population with the unique information from specific group, creating more accurate and tailored risk assessment. So we also look at the theory and statistical method in actuarial work. What are the fundamental probability concept? Probability theory forms the mathematical backbone of actuarial science, providing the framework for quantifying uncertainty in risks. Actuaries use probability to model random events such as death, illness, accident, and financial losses. Key probability concepts include random variables, probability distribution, expected value and variance, joint and conditional probability, and law of large numbers. Probability distribution. Well, let's start from random variables. Variables whose values are determined by a random phenomena such as time until death, claim amount. We also have probability distribution. Functions describing the likelihood of different outcomes, the normal, the exponential, the gamma, the Pareto distribution. We also have expected value and variance. Measures of central tendency and dispersion used to characterize risks. We also have joint and conditional probability, tools for analyzing relationship between multiple random events. Law of large numbers. This principle that averages of random variables converge to expected values as simple size increases. Also have statistical methods. Actuaries employ various statistical techniques to analyze data and make informed decisions. Descriptive statistics. Actuaries use measures like mean, median, or standard deviation, skewness, and kurtosis to summarize and understand data characteristics. Inferential statistics, method of drawing conclusion about population from sample data including hypothesis testing, confidence intervals, parameter estimation, maximum likelihood as estimation method of moment. Regression analysis, techniques used for modeling relationship between variables. We have linear regression for continuous outcome, generalized linear models for insurance application, logistic regression for binary outcome, survival analysis for time to event. Application in insurance. In insurance context, actuaries use probability and statistics to price insurance products, establish reserves, assess risks, design rating system, and perform capital modeling. While price insurance products calculate premiums that adequately cover expected claim plus expenses and profit margin. Establish reserve, eliminate liabilities for future claims, assess risks, evaluate the probability and severity of potential losses. Design rating system, develop fair and competitive pricing structures. Then perform capital modeling, determine appropriate capital levels to maintain solvency. Life contingency. Life contingency is the study of events dependent on human survival or death. This area combines probability theory with financial mathematics to value insurance and annuity products. So the key concepts include the survival function, the probability that an individual survives to a certain age, what the cause of mortality, the instantaneous failure denoted by mu, that is the U, is representing the rate of mortality at exact age. Life tables, actual tables showing the probability of death, survival, and life expectancy at age. The complete life tables include the LX, number of survivors to number of deaths between ages, probability of death within 1 year, and probability of survivor and complete expectation of life at age. Probability tables are fundamental to the actuaries used to predict death probability and life expectation. These tables are considered for population data and refined for specific groups. Types of probability mortality table: we have the period life tables, the cohort life tables, the select and ultimate tables, select period and ultimate period. Application of life contingencies and mortality tables. Life contingency and mortality tables are used to value life insurance policies, price and reserve for annuity products, calculate pension obligation, assess longevity risks in retirement planning, design reinsurance structures, and conduct asset liability management. Thank you for listening.